Hello, everybody. It is one day before Election Day, and this year it doesn't really mean that much, given that two-thirds of the votes seem to have been cast already. But the official Election Day is tomorrow on November 3rd, so it is Monday, November 2nd right now, 2020. And we have a little bit bigger crowd than normal on a Monday night. I wonder why. So I wanted to answer some questions that came up on in the chats and turn these into some articles to help you out for shortcuts. You know, everybody loves a shortcut. So when I screen for stocks, I am generally looking for just a handful of things, because when you take a look at all the different things on a balance sheet or a cash flow statement, I guess I would ask you, what does this mean to you? Doesn't mean a lot, right? Because it has to be the basis of a comparison. So whether you go to the balance sheet or the income statement or the cash flows, you just kind of look at it and you're like, oh, wow, that's a lot of numbers. So I break it down to a handful of things that help me screen and help me sort. So I'm going to go through those real quick. PEG, forward earnings. What is PEG? Price to earnings to growth. So this is a pretty simple way of taking a look at analyst expectations and what the current valuation is and what it's going to be against the forward earnings. And generally, you want a PEG ratio on a dividend stock of around 2-ish, right? And on a growth stock around 1. And you want that to be so to give you some margin of safety in what you're doing. Now, a lot of these don't have that low PEG ratio. So the question you should ask is why? It's not an automatic disqualifier. You got to ask why. So you take a look at Walt Disney. Walt Disney has a PEG ratio of 680. Why would it have a PEG ratio of 680 right now? Come on, somebody should be able to figure this out. What's going on with Disney? Very good. The earnings are depressed from COVID, and there's no growth right now. So when an event happens, the ratios get thrown out of whack. And sometimes when these ratios are way out of whack because of an event like COVID, you go, maybe that's an opportunity. Starbucks, same thing. They had to have to shut down some stores. Illinois Tool Works, they had to shut down their manufacturing for a while. Now Lumen Technologies, they just have a crummy growth rate. And you go right down the list. And now all of a sudden, half of the list, you take a look and you go, oh, look, a lot of 2s and 1s. That's what you want. Think of it this way. If the price of something is 100 and the earnings are 10, that means it would have a price to earnings ratio of 10. And if you have a growth rate of 10%, that means your price to earnings to growth is 1. Maybe Taiwan Semiconductor would fit into that, or Qualcomm, something along those lines. When your growth rate is higher than your price to earnings ratio, and think of this as an inverse, that's usually good. So you want a growth rate that suggests that the price to earnings ratio is probably a little lower than it needs to be. What we've learned over and over and over again is that in these big rallies, most of the gains in the stock market have to do with price to earnings multiple expansion. It's not that these companies are earning more and more money. I've shown you the charts that revenues have been relatively flat across the board in the S&P 500. Earnings have only gone up a little bit, mainly having to do with efficiencies derived from machine learning. So we're not really seeing a big expansion of revenue, even excluding, this year. So over the last several years, we haven't seen revenues gone up, but we have seen the price to earnings ratios get higher and higher, which we know is dangerous. So by adding growth, it gives you a better metric for figuring out, is this really something that I want to be involved with? You take a look at Apple, and it has a PEG ratio of 2.4. That's pretty interesting. That means that on this little correction, maybe being the best company on the planet, it already has a PEG, PEG ratio, that's almost 2 or below. Whenever Apple has historically had a PEG ratio below 2, you'd have been kind of silly not to buy it. Greenblatt earnings ratio is a measure of EBIT to enterprise value. And this has really been a generator of pretty big gains when you measure for it and when you can combine it with the PEG ratio for forward growth. So if you take a look at Barrick Gold, that's a pretty good earnings yield. What it means is that earnings are probably going up. And when you take a look at sales growth for next year of 9.3%, you go, that's pretty good. And then they have forward dividend growth of 18.5%. They're not buying back any shares yet, but they've got a ton of cash laying around because they have a quick ratio that's very high. So when you take a look at these different factors, basically saying, okay, it's not expensive based on future growth. Again, it's got good earnings. It's got sales growth. So you put these three things together, and it gives you a pretty good idea of how well the company is doing. Forward dividend growth is nice. If we rank by forward dividend growth, what do we know about the ones with a negative? It means they had to cut their dividends this year. Look at all the companies that we have that actually still increase their dividends. Newmont, huge dividend increase over trailing 12 months. These companies all keeping their dividends the same. I'd have to double check Disney. I don't know if they ended up cutting their dividend or not. And again, buyback yield. We always like to see our companies buying back shares. Again, Apple, it's a tough company not to want to earn. I started adding these colors again earlier today. The green ones, these are the stocks that really anybody can own, whether you're a growth or dividend investor. The ones without a color, I don't know that they have anything. They're not our super blue chips. The green ones could actually be blue. In fact, let's have some fun and change them to blue. So these are our super blue chips. Companies that if we can get a hold of, dividend investor, growth investor, we probably want them. Cayenne, I believe is how it's pronounced. These are foreign companies. Kinder Morgan, the red, means I'm probably not going to be adding to this company in the future. I'm just waiting out the mergers and acquisitions that I expect. So I don't know if I'm going to even keep Kinder Morgan on the list once it goes up to about 15, 16. I think I'd probably take it off. It's dirt cheap now. And I don't think it hurts you to buy it now, but I don't know that I'm going to keep it forever. So 15, 16, 17, that would be back to even plus the dividend for me. And I think I'd probably be pretty happy with that and then swap it into one of these super blues or Taiwan Semiconductor or Barrick Gold. Store Capital, kind of a comeback story, right? It lost a lot of rents for a few months, and they had to stop buying back shares and issued a couple shares. But I think that among the REITs, this is probably one of my favorites because they just spit out cash when the economy is good. In any case, those are just some of the things that I screened for here. And the reason I brought it up is somebody was asking me today, what am I looking for with these companies? And I made the point that, there's a lot of things out there that people look for, and it really is too complicated. Once you understand what a company really truly does, which comes from reading their presentation on their website, and a couple of their last presentations on their website, and then reading a 10K and a 10Q, that's your base reading if you're going to invest in stocks. Don't ever ask me a question that is right there in their investor presentation, because I know that you cheated. You didn't read the material, right? That's like going to school and having a history class, and the teacher says, who wrote the Declaration of Independence? And you're like, well, it was that one guy. It's just do the reading. And if you can't do the reading, don't buy stocks. But once you understand the basics of what a business does, and you can start thinking to yourself, are their numbers good, right? You're just looking for a couple of things. You're looking for growth rates, right? And these are dividend stocks. You're looking for positive growth rates. Right now, Lumen is the only one that doesn't have one. And once they spin off their consumer side of the business, they will have a positive growth rate. So this is one of those questions. You go, why do they have a negative growth rate? Because their consumer division is losing customers slowly. But once they sell that, not only will they be able to reduce debt, but the other divisions, the business division and the fiber, are both growing. So that falls under the category of what is the market missing about this company. And with any of these companies, what I got to in narrowing it down to just a few factors is, what is the market not valuing with a company? What is the market missing? And these numbers, right, they're not automatic. Oh, look, positive, positive, positive. Buy it, buy it, buy it. No, that's not how it works. You get as much information from a number like this as you do a number like this, right? We know that Newmont's in this huge rally, and Barrick Gold and, Apple's led the market. But this number here, it should scream out, what is the market missing? Why would Kirk put a stock with a negative sales growth rate on one of his lists? Because the market is missing something about the dynamics of this business. And once they make the change in selling off their consumer division, all of a sudden these numbers all get better. And what do we know about rates of change? And what do we know about change? When the market sees something change, or the rate of change increase or decrease, the market makes an adjustment. So if suddenly they sell their consumer division and this number goes up to 15%, and they have that cash fall to the balance sheet, even though the company will be a few $1 billion smaller, they go, hey, it's growing. And then maybe all of a sudden the market cap jumps because they get a better PEG ratio. The market expands the valuation. So that's what Lumen Technologies is. It's a play on a strategic transaction to see the valuation get improved because the growth numbers improve and because the balance sheet improves. So that's the sort of thing that you want to understand about any of these companies. And most of these companies are just great companies. But some of them, you're looking for something. So Lumen, kind of a turnaround play. We need them to sell the consumer division. AT&T, we need them to sell Warner. Store Capital, we need people to start going back to stores. Pretty easy. Disney, we need people to get back on, Magic Mountain. Once you know that stuff, and you can summarize it, I just call them the Kirk factors. There's one or two I haven't added yet. But it's a simple approach. You take a look and you go, okay, what else do I want to know about a company? Forward dividend growth, and then the buyback yield. These two things together are shareholder yield, and I want to look at them also in the context of debt reduction. So the definition that these guys use for shareholder yield, which I don't have on here because I don't like the definition they use. Teresa pointed out, I don't think she knew, but she asked me what shareholder yield was, and what shareholder yield is the combination of share buybacks, dividends, and debt reduction. So Meb Faber talks about shareholder yield in a couple of books. And what you want is a company that can return money to shareholders without having to increase borrowing. And in fact, decrease borrowing, pay off debts. So the combination of paying off debt, improving the balance sheet, giving you a dividend, and then reducing shares not only makes it less dividend that they have to pay out to the public, but that's more money to go to debt reduction or whatever else they want to do. And it tends to increase the price of the shares because there's less supply. So a good shareholder yield is incredibly vital to a lot of these companies. In fact, I can add it here, even though I don't like their definition, and you can see that the shareholder yield here is pretty good. Why are AT&T and Lumen at the top of this list? They've been paying down debt, and they pay out a big fat dividend, and they haven't had to issue shares. In fact, AT&T bought a few back. So even though they don't have growth rates, they're treating their shareholders well. What happens when they have better growth rates and a big hunk of money from selling a hunk of their business? It makes you wonder, this PEG ratio is going to, drop down to 3 or 2, which means, a big jump in share price. Normally, you want a shareholder yield of 7% or higher. I think that these are all pretty good given what we're going through right now. Historically, they've been higher. I'm using the quick ratio as to give me a hint on where they stand in their balance sheet. What is a quick ratio? It's basically just current assets minus their inventory divided by liabilities. That's it. Do they have the ability to use their most liquid current assets, bank accounts, cash, things like that, to pay off their debts that are coming due in the next year? So you want a company with a ratio above 1 because it means that they have enough cash to pay off anything coming due in the next year. And most of these companies do, right? Store Capital's got a boatload of cash just sitting there. Flip it around, you take a look and you say, okay, what's the deal with these companies? Well, Nutrien saw less fertilizer this year, so they might have to do some short-term borrowing, which will be no sweat for them. AT&T, you see that they're selling off little billion-dollar pieces of their business here and there. They still have the big one to sell. And again, they have a ton of credit. Starbucks, they had to shut down. Their ratio is normally over 2. Home Depot, they've just been paying out a lot of money and expanding and buying a ton of inventory. Brookfield Renewable, that's something to watch. We have to make sure that everything works out with their build out because they're growing fast. And sometimes companies that grow fast get out over their skis. But most of their contracts are financed and they have third-party payers. So unless somebody welches on them, they probably don't have a problem. Kinder Morgan, we should be worried about somebody welching on them. That would take a long time for them to get screwed. But in short, they're paying out a ton of money and most of their liabilities are due every 3 months, right? The dividend. So this only being 2 quarters ahead is not that unusual. We would like to see this back up to 1 though. So we'll have to keep an eye on that. My thinking, even though I think that this is a valuable company from the standpoint of just value, if you had to do the company yourself, right? If you had to start this company, you couldn't do it. This company is irreplaceable. The problem is nobody's buying their damn shares. So that's the real problem, just because they're fossil fuels. And I think that I'm probably going to exit this in the next year or 2. So if you're not in it, I don't know that you need to add it. But if you're trying to make a trade, go ahead. I don't think it's the easiest or most lucrative trade. So I don't know that, unless you're a dividend investor and you just want to collect that dividend because it's big and fat, which is cool. And then, when they go through their strategic transaction, then you won't have it anymore. And then Lumen Technologies, they have a lot of cash flow, so they typically don't need this number to be real high. AT&T's on that list too, right? With all that cash flow from people paying their bills, they don't really need to have a giant quick ratio. But again, we'd still like to see these up closer to 1 or right at 1. So these are things that we should at least pay attention to because we don't know how badly they're being hurt by COVID. Flip on over to the growth stocks, and you'll notice something different about the growth rates. Highest one here is Qualcomm at 32 and then Newmont at 20. These are much higher growth rate stocks. So we want to see huge sales growth on our growth side. And one of the screens I run is I don't even look at stocks that don't have a growth rate of 20%. I think that that's something that you should consider because a couple of people asked me about good stocks this week. And remember what I said way back when, and we'll go over it real quick, is in the getting started, right? Ignore good stocks. So I'm going to rewrite this just so it pops up and I'll refresh it. But you don't want to own good companies. You don't. Don't think about buying good stocks. Good stocks are not very helpful to you. Why? Indexes are full of good stocks. You can own ETFs to get good stocks. Anything that you buy should have the chance, should have the potential to be great. It's not going to move the needle if it's just a good stock. If it performs roughly in line with an index, maybe makes you an extra point or 2, but it's a single stock, so there's more risk than an index or an ETF. So unless you can beat the market by I usually say at least 4 points on average per year, but really you're looking to beat the market by, 50% or double. 4 points is typically about 50%. Unless you can really, really think that you have an opportunity to crush the market, you shouldn't be buying stocks. So you can throw out 80 to 90% of all the stocks on the stock market as individual purchase candidates. You're looking for that top 10 to 20% of companies out there that have a chance to be market leaders, because that'll move the needle on your portfolio. And when you identify companies like Square and Roku and Micron and Nvidia and Amazon, what you realize is you're actually increasing your margin of safety, because these are the best companies. And you have growth rates like this, all you have to do is figure out, okay, when is it time to buy it? Typically, you want this number to be between 2 and 1. Freeport-McMoRan, the reason that's so low, because they're not earning a lot right now. They just came out of having negative earnings. So this could mean one of two things. If they are heading down into negative earnings, it means this is a sign of something bad happening. Again, the numbers only tell you something if you know something about the company. Because this was a negative number, now it's a positive number, it tells you the earnings are going up. So in this case, the 0.1 is positive. If it had been going the other way, it's a negative, right? If their earnings were going down, this would be a negative. Pulte Group, right? They're starting to make more and more money. PTC is cheap for what they earn, and I'm very bullish on their future. Their sales growth for next year is not quite what I'd like, but I think that as more and more companies in industry go to machine learning and automation, this number goes up. Companies are just short on cash right now. Just like why we take a look at Itron, we say, well, it's actually not a bad PEG ratio, but look at that sales growth. Why is the sales growth here? We've talked about this. The municipalities in the states are short on cash right now. So in this case, we're waiting for that to change. In this case, we're waiting for companies to have a little bit more free restraint on their spending to upgrade. Now, the other thing that we want to throw in here after we get through the fundamentals and understanding our companies is relative strength index. This tells us, and these would be daily charts. This tells us about when we should be looking at a company. So on the daily chart, you want this number to be in the 30s or 20s. So here's EA. On the weekly chart, it's coming down, but it's not quite oversold on the weekly. But we don't know if it's going to get all the way down here again. But for sure, we want it to be in this, even with the spring at least, right? So to get down to about there, somewhere in the 30s. On the daily chart, it's already pulling it down. So what you'd want to see is for a week or 2 or 3, this hanging out down here, the daily chart, every Friday pushes or pulls this, right? Because this is a weekly chart. It ends at the end of the week. We still aren't seeing a lot of these stocks closer to their 52-week lows and their 52-week highs. And when the stocks are near their 52 weeks, we have to ask the question, are they breaking out? Are they running into resistance they can't get through? Alibaba, I'm not so sure that we didn't screw up when we didn't buy this one at 160, 180. So we may not see this one back down here. You might have to buy this one in the middle. It might be breaking out. Ford, on the other hand, was so far down that I think this represents a breakout when the world finally loves the idea that they're going to go EV and hybrid, which apparently, according to the CEO, he's going to tell us in the spring. So on a big update, if we get another big morning tomorrow, those calls that I have for January, I'll probably sell. And I'll end up breaking about even on it. And then I'll just have to wait for a pullback, and then I'll buy calls again. Somebody asked would I sell puts on KMI. It depends on who you are and what you're using them for. If you're an income investor looking for income, right, you could sell puts on KMI, but the measurement that you need to make is the premium high enough for me to bother doing, or should I just buy the stock, right? I think that's the question you have to ask. The dividend's so high, is it worthwhile even selling a put? I suspect that it is, because this is fossil fuel, and you probably trying to see if the Packers made a trade here. It's fossil fuel. And you say, okay, let's see. If I was going to sell the $12 Januaries, I'd get 90 cents. You know, that's not bad. That's 7.5% between now and January. And if it gets put to you, you're collecting a big dividend. So sure, you could sell the put on Kinder Morgan. They're not going out of business. I just don't know that anybody in the whole world's going to ever buy their goddamn stock again, and no matter what they do. And that's my concern with all the fossil fuels, is who's going to buy their stock. You know, so as good of a company as I think this is, sentiment is so bad in fossil fuels that it doesn't matter that this is valuable right now. Now, if you're thinking over 10 years instead of 10 minutes, you take a look at this and you go, okay, we're going to have natural gas pipelines for 30, 40, 50 more years. There's not going to be many more built because the right-of-ways are hard to get. Kinder Morgan's another one of those companies you can't replace. So yeah, I think that you can sell the puts. I think you can buy the stock. You just have to be patient and understand that this is for a portfolio where you're not looking to triple or quadruple your money in 5 or 6 or 7 years. So with this portfolio, with a dividend investor portfolio, where you're just looking for something that really can't go out of business, something irreplaceable that can't go away, and you want the big fat income, and you're willing to wait a year or 2 or 3 for you to get your principal back, if you're in at 16 like me, you know, then you go ahead and do that. And when I say me, I mean I have dividend clients that are in this stock. I don't own it, you know, because I'm in all these growth stocks. But you know, for a retiree who wants some hedge into fossil fuels with the idea that they're not dead yet, and a big fat dividend, and a very likely strategic transaction, and you can live with the sentiment being bad because millennials will never buy it, then yeah, I think it's worthwhile. Because at some point, they're just going to be kicking out so much dividend income that, you know, every old guy on the planet's going to buy it, right? They're going to say, oh, I don't care what the kids want to do. It's paying me 10%. They ain't going out of business. So I think that's the way that I would look at it. So I didn't really come prepared to do a lot of charting, but if there's something you want to talk about, we can. I've been playing with the REITs, and with financial stocks, you have to use different metrics. And one of them is FFO per share. So the problem with a lot of REITs this year is they have no free cash flow, basically. This is a measure of their free cash flow. So this is funds from operations that can be distributed as a dividend because they have to distribute 90%. Well, you've got a bunch of these companies that have negative, essentially, for all intents and purposes, that's negative earnings, which means that they can't really afford their dividend without borrowing. So when you rate it this way, what you start seeing is, okay, who's got a good coverage ratio? And you just start eyeballing this and go, okay, Equinix, what do these guys do? They've got twice as much distributable cash flow as their dividend. You go, okay, well, what do they do? Pull up your research report. You go, these guys are in data centers. That's a pretty juicy business. I don't know why it was listening to me. I don't know what I said to make it do that. So this is one of the companies. Equinix is one of the REITs that I'm looking at. So I've already got it marked. American Tower, if it ever got cheap enough. Unfortunately, on Stock Rover, it won't do this ratio for me. The FFO to dividend per share, I'd have to build it, so I probably will. I'll probably do my own REIT. I'm probably going to take this and create my own REIT factors. So I'm going to divide FFO per share by dividend per share. The problem that we have right now is so many of these companies have disrupted rents. So I'm using historical data to try to see who's undervalued relative to what they should do in 2 years versus, you know, what they're doing today. And that is a long, painful process. I will tell you, I have looked at so many of these that I just don't want to think about REITs anymore. But I will tell you this. REITs are way overrated as an investment, way overrated, because a lot of these companies need massive capital spending to take care of their properties. So there's only certain ones that have low maintenance properties that are easily convertible into something else, and command rents that are going to rise over time. I mean, that's really the long and short of it, is that a lot of these companies, if it wasn't for the favorable tax code, they would not be that profitable. And if you've ever been in real estate, if you've ever been involved in a real estate development project, I've got one under my belt, and I've got friends who are pretty big time flippers in the Milwaukee area, is that the money made in real estate, for the most part, is in redevelopment. So if you know any flippers, you know that when they find a crappy property, but it's in a good location, and they spend the 30 or 50 or 100 grand or whatever it is to fix it up, the money that they make in selling it is usually the equivalent of 3, 4, 5 years of rent. So why would they rent it out when they can sell it and just move on to the next property? And they just chronically are getting multiple years of rent when they sell a rehabbed property. And the same thing is true with commercial properties. When you can buy a commercial property dirt cheap and rehab it and then fill it with tenants, you're going to do pretty good. But if you can rehab it and flip it to some private equity firm or REIT that wants to own it, you're going to do better. You know, you're basically pulling forward all sorts of rents as current income. So a lot of these REITs, I will tell you, half of them for sure are junk. I mean, there's just a long list of companies here that are just craptastic. And that's why the ETFs in the REIT space don't work. It's because they're filled with the craptastic companies too. So you have to go through these one at a time, and it's just a monumental task. And you know, I belong to a REIT service on Seeking Alpha. It's the only one that I belong to. I belong to High Yield Landlord, and I told you I learned some things from him. But one of the things I really learned is they have no idea what these companies do. They just don't have any idea how the math works, how the capex works. And you've heard me talk about capex over and over again. The amount of money that a company has to put in order to pull something out is a big deal. That's why the tech companies that maybe you'll put $1 in and then get 30 out are such good investments. These companies will put $1 in, maybe you'll get $1.50. So the capex versus what you're going to get out of every dollar that you put in, every dollar you put in, what you get out of it. Think of it like, I know some of you are small business people. If you advertise, you put $1,000 into advertising every month, and after the first 90 days, because you don't usually expect much up front, you start getting $3,000 a month. That $1,000 in advertising generates $3,000 in revenue. You're like, okay, I'm going to keep putting that $1,000 in. So a $1 bill turns into a $3 bill. Think of that from the standpoint of capex, what they're putting in to what they're getting out. A lot of the capex these companies are doing is just pure maintenance. They don't get anything out, nothing. And that's something that I think that you need to be very aware of when you think about REITs. So I'm going to have a dozen REITs. I thought I was going to have 20. I'm not. There really just aren't a lot of great REITs out there. I'm going to have a dozen REITs on top of the ones that we're already following. And from that basket, you can build your own REIT ETF by owning 5 or 6 of them. And I think that will be a way for you to have real estate exposure with anywhere from 8% of your portfolio up to 16% of your portfolio. Again, depending on who you are and what you're using your portfolio for. So if you are a retired dividend investor, you go about 16% in REITs from an asset allocation standpoint that's valid with the statistics, to not get you too overexposed to that sector. It still would be way higher than the percentage that it represents in the S&P 500, but those fat dividends are awfully nice. So the main thing we want to look for is a dividend that is growing, because the rents don't suffer in recessions, right? The rents don't go down when there's a bad economic event, and that rising interest rates don't hurt them either. And this idea that interest rates are lower forever, I just think that the long end of the curve, at some point in the next year or two, we're going to see it rise. And once the long end of the curve rises, that represents mortgages. So we have to make sure that our exposure to real estate isn't hurt because the mortgage rates go up. That increase in cost has to contractually, and certain companies have that, certain companies don't, contractually passed on to the renter. All right, somebody asked me about SRG. What is SRG? Seritage Growth Properties. SRG has underperformed not only the S&P 500, but it's way below the sector and even its subsector. So why is that? So let's find out what they do. Is this the old Sears? Is Seritage the old Sears? Because that I know something about. Cacao. Is Seritage the old Sears? So Eddie Lampert has used this as a way to extract wealth to himself. And the problem is that Eddie Lampert is a greedy bastard. So I wouldn't touch anything that Eddie Lampert is involved with, because he's the only one that's ever gotten rich. Eddie Lampert basically took Sears, didn't have the brains or the care to realize that that industry was changing, and he borrowed money in the business's name, but then he wrote the contracts so that any money that did flow through went to him first, and they ended up declaring bankruptcy. And when they spun off Sears, he set it up as basically a way for him, because he screwed the other creditors in bankruptcy court, so that he'd be able to extract money out of this. One, I don't know what these properties are worth anymore. So if you were a true vulture investor, that's what you'd have to figure out is, are the properties that they'll end up liquidating worth 25 and not 12, right? And for you as a retail investor, is the risk too high to maybe try to double your money? And I'm just throwing it out there. I don't know what those properties are worth. The thing that I think you really ought to consider though is this. It's not even worth $1 billion anymore, but Eddie Lampert has made like whatever it is. What's he worth now? 13 billion, 14 billion, 15 billion? Somehow Eddie Lampert got control of Sears and Kmart. Didn't really try to make them competitive. It just sucked as much cash flow and money out by manipulating the contracts and the bankruptcies and the bonds and the whole works. So as you might guess, I think Eddie Lampert is a white collar criminal, a greedy, unethical fuck. I would not want to invest with him. That's my opinion. If you're a vulture investor and you want to try to figure that equation out right here, have at it. And may God have mercy on your soul, because I have no idea. Stag, I know. These little guys, are these the metal guys? Is that who these guys are? Warehouse and distribution. Yeah, interesting, right? There's another company that bought a bunch of steel mills. It has a similar name. It has industrial in the name. In any case, so again, trailed the market, but what concerns me is that it trailed the real estate sector, right? Sentiment's real low. So this one becomes, again, another math equation is, are these industrial properties that they own and warehouses that they own worth more than what the share price represents? And I don't know the answer to that. So again, on something like this, what you would have to do, is this the one that I looked at 2 weeks ago? You have to look at the properties, because there's one in Wisconsin that I looked at, because there's like 3 of them real near me. I would know if I looked at the website. They have a lot more in Wisconsin than what I looked at. So the other company, I looked at a company just like this for you guys a couple of weeks ago. The trick with these is trying to figure out ballpark what this stuff is all worth. And right, that's a pretty enormous task. So you have to come up with shortcuts. Chippewa Falls, Milwaukee, Caledonia, that's probably worth something. This is near paper mills. Oh, this is out in Madison. This is not these probably aren't very valuable. Yeah. The problem with these, and these are, I actually know exactly where these are. Oh, you know what's funny about this? This building here, These two buildings right here, they're right next to each other. It might be, yeah. Well, anyway, these three properties or these four properties on 104th Street, we looked at buying one of these and turning it into in the short term, it was going to be for growing vegetables. In the long term, it was going to be for growing something else. But the city of West Allis would not let us do it. We had the money all lined up, actually. So that's funny that these are the owners of that. These are good properties. They rehabbed them. They put a ton of money into it. They used to be shipping distribution. So in any case, when you take a look at these, you have to try to figure out where are they against long-term valuations. This PE of 42 screams that the earnings dropped, right? So they had a lot of people not pay them. The share price dropped. It's not back up here, but that was probably a rich valuation. That was probably a low valuation. My guess is that they're fairly valued, meaning that there's not a lot of upside and not a lot of downside. So they're probably about where they belong, plus or minus, because that was probably too high and that was probably too low. So when you take a look, you say 4.6 dividend yield, are they going to see rents really increase a lot in the next couple of years? They have to probably make up for vacancies. So take a look at the vacancy rate. That's why I say these REITs are just so hard to invest in, because the properties, there's so many properties. You really have to try to figure out what they have working for them. And even if they drift upward, right, to this price again, how many years is that going to take? And would you be better served in something that has more growth? And again, I think we always have to ask the question, who's going to buy this stock and bid it up for you, right? So any of those REITs, I take a look at the list that High Yield Landlord has, High Yield Landlord, and I look at these and I just think to myself, a lot of these, nobody should own this many freaking REITs. It's insane. It's insanity. There's just no, and everything's a strong buyer buy. I got a couple holds. Stag is one of their holds. I don't know what to tell you. There's no way. We know that 80% of the stocks out there you shouldn't bother with, give or take. How can these all be strong buys and buys, right? Simon Property Group, strong buy. That is complete and utter horseshit. They're trying to buy J.C. Penney, which is a piece of crap. Unless they get it for almost free, and again, I haven't looked at the deal, I wouldn't bother. Now, the one on here that I'm interested in is Empire State Realty Trust, because I don't think Manhattan's going to be long-term in the dumps. And they own some pretty good properties in Manhattan, including the Empire State Building. So Empire State Realty Trust is actually kind of on my secondary list. I already mentioned Vici Properties to you. That was on our rebound list. So, I've gone through a lot of these. Iron Mountain, for him to have it rated as a buy, it just means he doesn't understand the business. I know people at Iron Mountain. I've asked them about the business. They're looking for other jobs. They're trying to get off. They're trying to get off the ship. They're trying to get down the line to the shore. So, it's just kind of garbage. ESS, AVB, ACC. I liked agency-backed mortgage REITs. I think that they're wrong to not like the mortgage REITs. The more and more I look at these, I just think to myself, how much risk is there really? Now that they're beat to heck on the price, right? So, where's my list? Oh, in any case, I've been going through these, and there's just so much. There's just so much. Lamar Advertising is junk. Outfront Media is junk. They're interesting to me. SBA Communications. Really, they own like a bazillion towers, but how are they ever going to generate any return for you? They've got a small dividend. So, and if you rank it by dividend, which is what everybody likes to do, you start taking a look at some of these and you're like, oh, who in their right mind could pay out a dividend like this? That means that something went wrong, right? Iron Mountain, junk. There's no way their dividend is secure. And that's the thing you got to look at is what do I know about this business? I know their core business is shrinking, and I know that they're not growing the new business, which is servers, fast enough because they got to compete with their servers for cloud. They got to compete with Microsoft and Oracle and Amazon. How are they going to do that? It's just a shield for the executives to get paid more and to leech more off of that company. And that's another thing. I'm telling you, the more of these companies that I spend an hour or two on, the more I realize that there is just a whole class of executives out there that are not doing you any favors, which is why you have to really selectively weed out all the companies that you think might be good, because who cares? Seriously, who cares? Who cares if it's a good company? Go work for it then. But don't buy the stock because you're not going to get anything out of it. You see, that's a good ratio right there. And I haven't looked at these guys yet. California and Seattle. Yeah, that's interesting, right? The thing that you have to work, what you really should look at with Essex then, out in that part of the country, is find out if there's any legislation working its way against them, right? Rent controls, things like that. I'd be very concerned about that sort of thing. On these research reports, what you really want to find are the REITs where the blue line is above the green line. You want REITs that have outperformed the REIT sector. Okay, so how can we find them? We go to momentum. Well, actually, this will work. 1 month, 6 month return. Look at the return on these REITs. That's brutal, huh? But now we're getting the ones that are positive. So that means that they probably beat the sector. So where are the companies that have done really well? Right? You'll notice I got a bunch of them marked. These are the ones that you want to look at. You know what? All these thoughts on certain things. American Tower, it's a good company if it pulls back. Yeah, you need to send these to me ahead of time in the chat. The Ask Me Anything chat. And give me more than what do you think. Ask me, what do you think about their blank? Ask, what do you think about their this part of their business or that part of their business? Because if you're not to the point of being able to ask that kind of a question, you haven't done your homework. So ask me a question about a part of a certain company's business, not any thoughts on. In fact, I forbid any thoughts on anymore. I won't answer them going forward. Any thoughts on Stags, properties in Wisconsin? That's kind of vague, but I'd probably go for it. So in any case, I mean, I have been doing the work on this. It's a lot more complex than I think people give it credit for, because I want to know what the heck these guys are investing in. And as much as I want Simon Property to be the biggest rebound story in the world, the fact that they're buying JCPenney just makes me sick to my stomach, right? Yeah, American Tower could raise. I mean, you have to check and see how those contracts work. I don't remember. But yeah, I mean, all the companies that have 5G towers are going to be doing telecommunication towers, which is going to be a great business for a long time. All these people who think that we're going to suddenly get cellular and data through satellites, they're so wrong. So wrong. Did you know that those are going to be like 1/10 as fast as 5G? They're going to be, it's basically be a 4G connection that you can use out in the country if you're using a satellite. So it'd be better than what you have now with EchoStar or whatever's out there still. So what Elon Musk is going to do with Starlink is going to be better than what exists for areas that don't have towers and fiber optics. But those areas are going away rapidly anyway. It's basically going to be, almost military command and control stuff. It's not even that good. But these tower companies are good companies, and they get super overbid because everybody knows that they're good. And you just have to decide, do I buy those on the dip? And I wish I knew the answer to your question, Oscar. I don't know the answer to that. Vici, I'll show you a chart on Vici. It doesn't make any sense. And I'm going to tell you this because I gamble, right? This was for sure overvalued up here. It crashed because they closed Las Vegas, and then it just shot straight up in a V. I will tell you, there's nobody in Las Vegas right now. They're open, but there ain't nobody there. I mean, they're literally at 20%, 15% capacity. And it's not going to change for another 6 months or longer. And all of these companies have to take on debt. So I think that this does, in fact, end up back down in here in the teens. And I'd probably buy it in the teens. But there's just no way I'm buying this up here. It doubled already. And that happened to a lot of these. Because people are like, oh, it fell. It's going to go right back. It's not going right back. It's going to take a long time. And what do we know about investors? They get impatient. They get fickle. They sell stuff. And a lot of people who were buying in here, and the reason why it's struggling now is because they got their money back, and they're like, I'm not so sure I want to be in this anymore. I basically got my money back. I'm out, Joe. That's where a lot of resistance comes from, is the people who bought and then got crushed. When they get around even, they sell, right? That's just a psychological thing that we do. So it doesn't really make sense. All right. As far as just the vast stock market goes, I'll tell you what. I think that rally on Friday afternoon, the last couple hours, and today it opened up about 400, 300, 400. It chopped around in there for a long time. There just isn't a lot of demand out there. And everybody wants to say that all the cash isn't come flooding in the stocks. It's not. Foreign demand for stocks is way down because it's no longer a safe haven. The United States is no longer a safe haven. That's why Buffett invested in Japan. And I'm looking for ways for us to get a little bit more internationally diversified. The ETF that I really think everybody should be thinking about, especially you dividend investors. Where'd it go? Oh, there it is. Right? This one right here. You really need to be looking at this one. The Wisdom Tree Hedged International Dividend Growth. It's been a good fund. IHDG. This is the one that I really think that you need to be paying attention to. Right? When you compare it to QQQ for 5 years, right? QQQ beats the heck out of it. But now compare it to S&P 500 instead. Pretty close. Now look. Pretty close. A little bit of a gap. 20, 30 points. Going back to the start of our QE. So ask yourself, it was real close there. Ask yourself, why is Buffett investing in Japan and Israel and a couple other places? I'm not so sure that there's going to be a big inflow of foreign money until we really get our economic engine roaring. And I do think that's going to happen. So I don't want you to not get into QQQ because you need to. But I think that this, for dividend investors, looking for something that's going to be a little bit better than the S&P 500 maybe over some years and give you a really good international diversification, I think that's something to take a look at. I really like this fund right now. When I take a look at the companies that it owns, I take a look in here, Novo Nordisk is a company that we've looked at, mining company, Tokyo Electron. You take a look at this, Nintendo, you start going, this is really interesting what they own. Pays a dividend, so not huge, but basically in line with the S&P 500. I would be taking a look at this. I think you got to have some of it. All right. Yeah, Wilson, I agree with you. I think Simon's got way bigger problems than people think. I could see that one going back to its lows pretty easy in the next 4 or 5 months. It's going to have a brutal Christmas season, right? Brutal Christmas season. If I had to guess, I'd say we were really close. The money's already flowing out of the stock market. It's only the Fed holding it up. That's an awfully dangerous game to play. So I will leave you with this. Some wisdom that I got 20 some odd years ago. Don't make a bad trade to make up for a missed trade. Yeah, we should have been a lot more aggressive in April. However, most of the gains in the market were made by June, and it's only gone up a little bit since. So don't make a bad trade to make up for the missed trade of a couple of months in the spring when you got that bottom of the V that came up real fast. The Fed has to protect the dollar at some point. Long end of the Treasury curve has to go up at some point, and it's probably a lot sooner than people think. If Biden, in fact, wins tomorrow, which we probably won't know till Friday, is my guess, then I think a lot of things change pretty quickly. And the problem that we're going to have is, does any stimulus get done before the end of January? That'd be my concern. I don't know what would get signed during the lame duck session. I have no idea how that would play out. So any volatility we should be able to take advantage of. And the good till cancel buy limits, I think, are all still good. But I'm telling you, I'm not using the first price on almost anything. I'm using the second price. I'm using the middle price and the low price. And if I have to switch this one, I switch this one. I'm really not using this first one. Just because I don't have a lot of faith in the fiscal stimulus. And I think that the problems are bigger than people think. And I don't know that we're going to have a coronavirus vaccine by summer. I hope, I hope the fiscal stimulus happens. I hope it's generous. I hope that, there's a breakthrough in the vaccine in the next month or two. And they say, hey, within 4 months, we're all going to have it. But I just think it's tough. With 23 million people getting some sort of unemployment benefit, another 3 or 4 million that that need it, but aren't getting it. We're around 30 million people unemployed, and that's just not good. And all these small businesses, I think that I think there's a big boom in small business that starts about next summer. But the next 6, 7, 8, 9 months in the market, can the market really hang on future hope for that long? I don't know, especially when that future hope hinges on earnings. And even though 87% of companies have beat their earnings estimates this earnings season so far, those are all earnings estimates that were revised downward. And that's why it hasn't had that big of an impact lately, is that we know that the estimates still are way below what they were in 2019. We've got a long way to go before we're back to 2019 earnings. Maybe 3 or 4 or 5 years, because those were juiced from tax cuts and Fed money, which were having a negative impact on the dollar. And like I said, there's trade-offs. So I wouldn't expect under a Biden presidency that they would focus on the stock market over the economy. They'll focus on the economy first. And if Trump wins, I think that the fiscal stimulus is difficult to come by. So, there's that. And that means that we rely on monetary policy, which means that the dollar gets beat up, which means that we head towards a financial crisis. And we get inflation with a slow economy, which is stagflation. So I really want to see who wins tomorrow before I go out on a limb on anything. But I do think the world gets better. I just think it's choppier and slower than people think. And we're going to get a lot of these prices. We're just like I said a year ago, we're going to get a lot of these prices. We're going to get a lot of these prices again. And this time we'll invest for the long term. All right. Take care.